What's going on, Digital Wildcat?
Guess who's back? Back again.
So we've been gone for a couple weeks.
Shady's back. Yeah, I did solo. We have figured out, because our average show is what, like 30, 35 minutes? Me alone was 17.
Oh, yeah?
So we've quantified.
We've quantified the contributions.
Yes, we have. I like it.
Evenly split down the middle almost. So anyways, I had a good show that I was going to do last week, but we had technical difficulties, so we didn't get to do it. But we're going to cover some of that stuff today. But why don't you, before we get into, my theme for the show today is energy tech.
Let's hit the big deal in the Delaware.
Yeah,
just real quick. First and foremost, everyone out there in Digital Wildcatters land, Collin's prostate has healed. He's back. He's healthy. He's here. Screw you for saying watch this dumpster fire when I was going solo.
I got like 3 messages asking about my prostate. I hadn't watched BDE, and I was like, I automatically knew. I was like, fucking Chuck said something about my prostate on BDE. So
exactly.
Anyways, I'm here. I'm good.
Okay, I'm gonna stop pointing when I talk about your prostate. That's bad. That's bad. No, so we had a big deal out in the Delaware. Colgate merged with Centennial. Have we hit peak oil and gas when an oil and gas company in the Delaware is buying a toothpaste company? Maybe we have. But so Colgate was a private company. It was backed by Pearl Energy. That's Billy Quinn's private equity firm. That was their big investment. Will Hickey and James Walter are the co-CEOs of that entity. Combined $7 billion deal, almost 200,000 net acres out there, 135,000 barrels a day of oil production. So a big company, biggest pure play in the Delaware. But this is what this tells us. Colgate was running kind of the independent track. When you have a big enough company, Collin, you draft an S1 to file to go public because that's always your threat to the other party is, hey, we'll merge and all this, but I'm doing this. So you got to make it worth my while. So I think what this tells you, because James Walter and Will Hickey are going to be the co-CEOs of the combined entity, they were willing to run a public company. So I think this tells you the market is potentially closed for a smaller IPO in oil and gas. So because they in effect went public by merging with Centennial, who's already public.
Yeah.
So I think that tells us something.
So your thought is that they kind of shop the deal a bit, just to get sentiment, and you think that there was nothing there? Is that?
No, I think what I'm saying is a lot of times you'll sell because you don't want to run a public company. If you're management, clearly these guys are willing to run a public company, and so they decided to merge with Centennial instead of going public on their own. So I don't know anything unique here on the deal. I haven't talked to any of the guys involved, but that just kind of tells me, okay, they had to do this merger with a public company and go public that way instead of just doing a pure IPO. Maybe the market's not open for a smaller company. Maybe, as this deal gets populated, because they're going to have a proxy vote on it, maybe we'll learn more. We'll learn more about synergies and the like. The market's kind of poo-pooed the deal a little bit. Centennial stock's down, it's trading at, call it 650 right now, and it's down $1.50 since the announcement of the deal. So maybe
oil and gas stocks just don't get any love. That's why I don't own any, because there's just no correlation with commodity prices. It's
I know. We're the biggest bull run we've ever had. But anyway, I will say this. I mean, the Colgate management team is a really, really good team. So this is what we've talked about a million times on BDE. Private equity company wants out. What do? They have to merge with a public company. They got about $500 million in cash. The rest they're taking in stock, and they'll bleed that stock out over time. So we, about a month and a half ago, we were talking about the IPO of the LNG ship company, and going, okay, maybe the market is opening for IPOs in energy.
Yeah.
This is a data point that says maybe it's not.
Maybe it's not.
So, but
Ryan Knuckles said that he's worked alongside the Colgate team for a few years. Incredibly well-ran company. The merger will create a premier player in the Delaware. Yeah, I mean, it sounds like Colgate.
No, Colgate. They're sharp guys. The Hickey family has a long lineage of folks in the energy business that have done really well. So
Colgate's the preferred oil and gas company recommended by 5 out of 6 dentists.
somebody better get to that 6th dentist and convince him. But no, hopefully.
I saw
Billy,
I saw a comment on Twitter the other day. Someone was at the Doug conference and said, if you're sitting here in these presentations, it's very clear that the common thread from all the oil and gas companies was about M&A, and he expected a surge of M&A. I thought that was interesting because, one, in 2020, 2021, we saw a massive wave of M&A and consolidation, and it made sense given a depressed commodity environment. What would be the reasoning for increased M&A and consolidation at high oil and gas prices right now?
I think investors are still beating you up in terms of watch your costs. So consolidation theoretically leads to lower costs. So you still have the investors bitching at you, pay a dividend, buy back shares, bigger is better. So I think that's there. You bring up a good point, because I think another subtle takeaway we can surmise from this is, you and I talked, call it 4 or 5 weeks ago on BDE, that I'd heard rumors that the bigger oil and gas companies were going to say, screw the investors, we're going to cut checks for assets because this is a buying opportunity like we've never seen before.
Yeah.
And they were just going to go bid. And if 1 or 2 of them won and stocks got pummeled, then okay, nobody else would do it again. This may be evidence that that's not happening, because you got to think that a private equity firm would take a check over stock, lag into it, all of that. So was there a big cash bid out in the Delaware? Maybe not. Don't know that, but maybe surmising. So yeah. I mean, so I think kind of looking at this deal, it's the same thing. Bigger is better. Cut costs. Pay me a dividend. Be careful with free cash flow. IPO market for a smaller standalone company, probably not open yet, and no cash buyers at stuff this big.
Yeah. I'll be interested to see if you see a wave of M&A, just because it didn't seem like you could have any more consolidation than what we had over the last couple of years. So just thought that was an interesting point.
The comment I heard about Doug, I heard the same thing, that everybody was up there preaching consolidation and all, but the subtle thread underneath it was, and I'm available to run the combined companies. So
yeah,
that's that.
I imagine that's always the hard part of mergers or smash cos within private equity portfolio companies is, the oil and gas industry is pretty infamous for dick measuring contests. So who gets to actually be the management team left in place and run the operation?
Well, people always say that oil and gas CEOs are stupid and dumb and all that. No, they're not. They're getting cash comp each year. And every time their options are worthless, they get them repriced. They're the best fucking investors in oil and gas there is. You know?
Say you're stupid all they want. But...
Exactly.
All
right. So what were you going to do last week when I was gone?
So there's a couple of interesting things at play here. One, over the last several weeks, let's call it the last month, we've had a lot of activity in oil and gas tech financing, which is interesting because, the genesis of Digital Wildcatters was when we started the Oil and Gas Startups podcast show. The common thread for oil and gas tech companies was that there was a lack of early stage capital for these softwares. And now you're starting to see Series B rounds coming from top tier Silicon Valley type VCs. And so Combo Curve, which if you're not familiar with Combo Curve, they're a accounting, reserve, forecasting software aiming to replace Ares, PhD Win, some of these older legacy tools. And they just raised a Series A, I believe it was $10 million, not that long ago, 6 or 7 months ago. And recently just announced that they raised a $50 million Series B. And you had some top tier VCs on there. You had Bessemer and Dragoneer. And so $50 million Series B for oil and gas technologies, a monster round. If you would have gone back to 2018, this would have really kind of been unheard of. And then
I think if you even go back further, it's unheard of. I mean, if you're talking pure kind of digital type technology stuff, not a new oil field service widget, maybe.
Yeah. So, I mean, you're seeing some serious capital allocations. And then Landgate announced their Series B, which Landgate is a land and mineral platform that they've just got a ton of data, both for mineral owners and for land groups. And this goes across the spectrum from oil and gas to renewables. And they raised a $10 million Series B that was led by NextEra Energy. And if you don't know NextEra is a leading renewable energy producer. And then
it's an electric utility that has a really good spin on it. But keep going. We
could do a whole podcast about that. Yeah. And then Kimmeridge also got into that deal last minute as well. And what's interesting about Landgate and Combo Curve is that they're both portfolio companies of RIG, the Rice brothers family office. And so Rice guys obviously have a knack for being able to get in some of these companies early. And then Mineralware, which Mineralware has been around, I think, for about 8 years or so. They were acquired for $18 million by SS&C Technology Holdings, which I'm not exactly sure what SS&C is, but it sounds like they probably have a portfolio of tech companies. What I thought was interesting about this deal was the acquisition price, $18 million, said that it was going to add $5.5 million of annual recurring revenue. So that's only a 3.3x multiple on annual recurring revenue, which is extremely low for a technology company. But a couple of things here. One, it's all cash. So there's a premium on that. $18 million all cash talks, especially when you've been you've been building the business for 18 months. And you got to look at macro things. I mean, just a year and a half, 2 years ago, we're in an environment where I'm sure Mineralware, just like every other company in oil and gas, didn't know if they're going to make it or not.
And random guys got fired. Yeah.
So, people just getting fired for being worthless, like Chuck.
Exactly.
So anyways, you look at this. This is interesting in its own right, because you look at Mineralware, and a fundamental problem in oil and gas tech is, I have VCs reach out to me over the last few years and like, hey, who's the next $1 billion oil and gas tech company? And I'm like, if I tell you that, you're going to pay me for that. I'm not going to tell you. But the hard thing is getting to $1 billion valuation based off of revenue. And then you get to that point, who acquires you? And your pool really shrinks down. You've seen Enverus over the last few years come in and scoop up companies like Q Engineering, MineralSoft, and those are typically in the $30 million range, which is like a really sweet spot for them. And so it's always been a challenge. How do you build $1 billion company in the space and then get acquired? And then all of this is happening simultaneously with more of a macro movement in tech markets, where go look up any tech company. Shopify is drawn down 80% on market cap. Snapchat yesterday crashed. They're down 79%, I believe, over the last 6 months. You look at Airbnb, go look at Robinhood, SoFi, literally every technology company that has been trading at a 70, 80x multiple in the public market has drawn down. And then you look at what's happened over the last 2 years. I mean, there's just so much funny money injected into the economy. VCs are investing in companies at 100 to 200x multiples on revenue, which is just insane, because used to, if you got a 15x, it wasn't that long ago, 5 years ago, you got a 15x, you were doing good. And so now all of these VCs, which I spied a little bit, but they're talking about, markets are crashing. We got to get back to fundamentals. It's like, fuck you. You're the one that was. You were the one cutting the check 6 months ago at 100x.
Sweetie, I really do love you.
Yeah. At 100x multiples. But, energy, it's clear that we're running counter-cyclically to tech, traditional tech. I had a software engineer from Netflix reach out to me the other day. And it was like, hey, really interested in oil and gas and energy. So, if I'm looking at macro trends, seems like next 10 years, there's going to be a lot of tailwinds here. Seems that technology is really cooling off. Found that to be really interesting because now you have talent that the energy industry needs starting to cycle through, but also capital flows seem like they may be cycling, that you may have some of these large rounds from top tier VCs looking at energy tech. But something I didn't get information on or data on, we should do this next week, is an evaluation of all the energy specs, all the electric vehicles, battery tech companies, because they've got fucking murdered over the last couple of months too. So it'll be, there's just a lot happening both at a macro level and at a just kind of micro level here in oil and gas tech. What do you think about all that?
So, note of full disclosure to the audience, I'm on the advisory board of Montrose Lane. So to some degree, I'm talking my own book here, but two just kind of random thoughts. When you look at the transition we're going to go through in energy, and we can say whether it's addition, transition, whatever, historically, the way things work is we adopt new technologies that are able to leverage the existing energy infrastructure. Because if there's going to be a hydrogen company that needs to lay all new hydrogen pipes across America, it's not going to work. It just isn't.
Yeah.
So in the course of doing that, hooking up renewables to traditional energy to grids, there is a massive amount of digitization that has to happen there. There got to be a lot of pipes, right, for all those assets to talk together. So I think for kind of the first time in my career in energy, because I've been talking about this. I mean, my pitch book I wrote at Stevens 25 years ago, Montrose Lane could use as a fundraising book, right? Mm-hmm. I was talking all about energy technology and the potential for doing this. This is the first time I think we've seen a real impetus for this to happen. So it's not surprising that you're actually starting to see capital flows there. The one thing I want to point out, and we've got to figure this problem out, and it's everybody's issue that we all need to. When I hang out and talk to energy technology companies, 95% of the discussion is, it took me 487 days to get approved as a vendor to Chevron. And then the next guy's like, well, I'm on day 282 with Chevron. And so adoption of technology by energy companies, particularly the bigger players, we've got to figure out a way to streamline that. And I think ultimately the solution to all of this is all these companies are going to get thrown in one bucket. And you'll have one publicly traded company, two publicly traded companies that are energy technology, energy software, whatever you want to call it.
Yeah.
And that would go a long way, because if you had 15 really great products and the one company was approved with Chevron, that will go a long way to actually achieving growth rates, integration, et cetera.
Yeah, Bobby Faxelrod said avoid the majors like the plague when you're first starting out. Couldn't agree more.
Yeah, Bobby's, I mean, it's like chasing the Holy Grail. Yeah, it'd be really great if you found it, but King Arthur never found it.
Yeah.
I mean, it's just...
that's also what makes the space really tough, is that the sales cycles are so incredibly long. And I remember back like in 2009, I remember a company that was raising, and they're talking to Silicon Valley VCs, and these VCs just really didn't have an understanding of energy. And then they're like, yeah, we want to see a little bit more traction. Once you get 50 clients, we'll be interested. And the company's like, once we have 50 clients, we don't need to raise any VC. We'll be cash flowing pretty significantly. And so from an operator's perspective, from a builder's perspective, it's hard to build a company when the sales cycles are so long, especially because you need those feedback loops to be able to build a product that's really good for your end user. And then from a cash perspective, I know guys, I'll give a shout out to Task here. Task has one of the best mindsets to building a company in this space. They haven't taken on any institutional capital. They raised a small seed round. They're like, hey, we think that we can build out to a few $1 million in revenue and then get acquired $30 to $50 million range. But they've had to eat shit for like 2 years to bootstrap that company and build the product and doing it themselves. And that is a pretty successful model of building out technology. but it's a hard. I mean, those guys left engineering jobs at BP to go make nothing for a couple of years, and so that's a tough ask for a lot of people. And then, you can go raise, say that you raise a $5 million seed round or Series A, you're gonna have pretty significant burn until you start flowing cash from one of these companies. So it's a hard chicken and egg situation.
I think part of this is even we can step up higher, and the whole mindset of energy has always been proprietary secrets, and we can't tell people what's in frac fluid because special sauce and all that. And I think that's the mindset of software buyers in the energy universe, is just, we got to build it in-house. We got a proprietary. Oh, if this is a good thing, we need to own it. And it's like, we need to standardize all that. I mean, 90% of the rest of the world, oh, that software seems pretty cool. Let's try it. Oh, it sucks. Doesn't work. Who cares? Instead of studying it for years and years. And then when you figure out it's really good, then you go try to buy it just so you can use it proprietary.
That's one of the most frustrating things to me about oil and gas is, first off, none of your shit's proprietary. None of it's secret. That whole notion to me is just mind blowing, especially in the era of shale. Okay, I get maybe when you're chasing conventional prospects back in the day, but those days haven't been around, at least in my career. And it's really eye opening, especially to me when you work with the Bitcoin mining community, how collaborative they are. Like, a lot of these companies are competing against each other, but like they know each other and they're friends with each other, and it's friendly competition, but it's much more of an open source environment. In oil and gas, very much closed off. And even to this day, it's still very much like that. And I think that that's changing a little bit with younger generations.
Because it needs to. It just has to.
And Bobby Faxelrod said, yet another reason to avoid the majors as well. They're just going to have you tell them how to do it and kick you to the curb. This is, could have a whole podcast on that, because that's something that has been a problem in the past. You come in there, they spend 3-4 months with you really picking your brain, looking at your technology, and they're like, oh, we'll just build this in-house ourselves. So, all right, ran over.
No, that's good stuff.
When we started our podcast 4 years ago, oil and gas startups, didn't think that would still be a talking point 4 years later, but here we are. We're still talking about it. So anyways, who's finger of the week? Majors?
Let's find out. Here we go.
All right, Chuck.
All right, the blowhards. God, what a week we had. So you had
the blowhards.
So, all right. So you had the Norwegian finance CEO, Kjerstin Braathen, said that energy shortages will cause some pain, but it's worth it. And you're kind of like, okay, really? People died today in exchange for people maybe not dying in the future? I'm not sure I get that. At least there's a little bit of recognition of the prescriptions they're advocating are going to cause pain to people. That's sort of new.
Yeah.
Alibaba's president, Michael Evans, is creating an individual carbon footprint tracking. Tell me how that's going to go over with Oilfield Rando when we have a monitor on him measuring how much carbon he's producing. And I'll get mine right after John Kerry gets his. You had Faith Birol, I think that's how you pronounce the last name, of the IEA, said, short term, we do have some demand for hydrocarbons, but long term, it's bad. So we really need to be careful and not do too much in the way of investment. Holy shit. Talk about falling off a cliff. So anyway.
I got my own finger of the week.
Hold on, one more.
Oh, you got multiple?
I got one more. Yeah, it was blowhard week.
Okay.
So the Shell annual meeting, there was a whole group that went in there, and instead of Queens, we will rock you, they were like, we will shut you down or something like that. They fucking trash Queen, man. You can go trash Shell all you want. I don't have any great love for Shell, but don't trash Queen.
Have some
Dude,
decency.
you touch under pressure, you're fucked. I'm coming after you.
Okay.
All right, who's your finger of the week?
All right, I got a finger of the week for this doofus over on Twitter. His name's Eldon Katz, and he starts going off all day yesterday on Twitter talking about how oil and gas companies are price gouging, and this is the first tweet that I said. Let me read this out. I should have brought up some screenshots, but I'm just going to read this to you. He said, he's like, quote in quotes, read an economics textbook is bootlicker speak for my religion has declared the people with the most economic power are actually powerless. If you're getting ripped off by companies making record profits, they literally had no choice in the matter. And then he goes on to say, I have legions of bootlicking economic geniuses in my mentions today who think oil companies have zero control over gas prices. They're all incapable of explaining or even acknowledging the fact that these companies are literally making record profits right now. So EFT gets into his mentions talking about, hey, oil and gas companies are price takers, not price makers. This is how the market works, and just got blinders on. He's not listening to it. And so then he tweets out, hold on, he deleted this tweet, but I got it screenshot because
nice.
Internet's forever, bitch. So he says, today I learned that oil and gas Twitter is a thing, and it's full of the absolute fucking worst people you will ever interact with. I feel flattered. When I see that, my heart feels warm, fuzzy. I love that we make someone feel like that that's incapable of intellectual honesty and understanding data, facts, economics, how markets work, not even open to hearing a discussion about it. So fuck you, finger of the week.
So here's what I think we need to do with this dude. Let's set him up on a blind date with Lindsay, and maybe they can double date with Alberta, and that'll be a freaking party for those guys.
I love that.
Welcome to Oil and Gas. I got two other quick things. Today is the runoff in the primaries. The Republican primary has the railroad commissioner race. You've got the incumbent Wayne Christian versus upstart Sarah Stogner. That race matters to us. Go vote. Voting is actually very important. And then the second thing I have, my parents' wedding anniversary. I think it's year 58 that they've been married.
That's crazy.
Thank you guys for getting together and fucking and bringing me into this existence.
I hope I'm sending that to your parents. I hope they get to see that. So congratulations.
Mom will be, what does fucking mean? What are you saying?
I don't know what you're saying, but I love you, honey.
How she raised 4 boys and remains this naive to this day.
All right, guys. Appreciate y'all tuning in for this week's show. We'll be back next week, hopefully with a lot of good energy news. Maybe do a review of energy SPAC market because I think that'll be pretty interesting. So
yeah, we'll take a look at that. Tomorrow I'm dropping on Chuck Yates Needs a Job with Brian Gitt. So we talk all through his story in a nutshell. Is he was a sustainability guy for 20 years because he loved the environment, and he woke up one day and became, to them, Ben Solo. It's kind of like, oops. But we go through economics of all that stuff, and he's a really thoughtful guy that cares a lot about the environment. So I think it's a good podcast. So make sure you subscribe to Chuck Yates Needs a Job, subscribe to BDE, tell your friends about us.
Cool. We'll catch you guys next week.